Today we look at the international monetary system and its the role in determining exchange rate. This chapter is around the fixed exchange rate, floating exchange rate, and what is the IMF? How does IMF do in the international monetary system? So in order to help everyone can be impressed in this chapter, we will be going to play the games in this class. I will show the proprietary words or the meaning of the word. Please describe the meaning or functions of the word. The international monetary systems refer to the institutional arrangement that govern exchange rate. In Chapter 10, we assumed the foreign exchange market was the primary institution for determining exchange rate, and the impressional market focus of demand and supplies determines the relative value of any two currencies. And now we look at the learning objective. There have 6 points. The first is describe the historical developments of the modern global monetary system. The second is explain the role played by the World Bank and the IMF in the international monetary system. The third is compare and contrast the difference between a fixed and a floating exchange rate system. Fourth is identify exchange rate regimes used in the world today and why countries adopt different exchange rate regions. The fifth is understand the debate surrounding the role of the IMF in the management of financial growth. The end is explain the implications of the global monetary system for management practice. And when the foreign exchange markets demand the relative value of the currencies, we said that the country is adhering to the floating exchange rate regions. Many of the world developing nations page their countries primarily to the dollars or the euro. A package exchange rate means the values of the currency is fixed relative to the reference currencies of the US dollar, and then the exchange rate between that currency and other currencies is determined by the reference currency exchange rate. Still, other countries have organisms with the fixed exchange rate, in which the value of the set of currencies are fixed against each other as some mutualists agree on exchange rate. Before the introduction of the year in 1999, several member states of the European Union operate with the fixed exchange rate. With the context of the European monetary system. For a quarter of the countries after World War II, the world's major industrial nations participated in the fixed exchange rate system, although this system collapsed in 1973. Some still arose that the world should attempt to reestablish it. The gold standard had the origin in the use of gold counts as the medians of exchange, the units of account, and the store of value, a practice that to ancient times when international trade was limited in volumes. Payments for goods purchased from and other countries was typically made in gold or silver. What is the machines of the gold standard? In 1880, most of the world's major trade nations had adopted the gold standard. Give us a common gold standard, the value of any currency in units of any other currency was easy to determine. The great strength claim for the gold standard was that it contains a powerful mechanism for achieving balance of trade equilibriums by all countries. A country is said to be in the balance of trade equilibriums when the income its residents earn from export is equal to the money its residents pay to other countries for import. Like the example of the textbook, now it only have two countries, is Japan's and US dollar, America, United States. Japan exports more to the United States than its import from the US dollars, and exchange the Japanese yen at the Japanese bank. The Japanese bank submit the money to the US government and demand payment of gold in return. There is the flow of gold in Japan. The US money supply was downward, while the fall in the price of United States goods will increase demand for these goods. The rise in the price of Japanese goods will decrease demands for these goods. So Japan will start to buy more from the United States, and the United States will buy this from Japan until the balance of trade equilibriums in achieved. Now we look for this video can understand what has happened for the gold standard between the words and what is the Britain's Woods system.
In this series, we rarely get far into the 20th century because it's hard to have historical perspective on events that are that close to our own time. But today, we're gonna have to roar into the latter half of the 20th century to show you just how recently this idea came to be. This idea that seems so normal, that we all take for granted as if it were always the case. The idea that money is worth something because we all agree it is. Last time, we talked about the growth of central banks as a patch system to fix the numerous problems that occur when you introduce paper money as the basis for an economy. But for many people, one more step was required to really inspire confidence in this idea of taking milled tree bark in return for their labor, and that was the gold standard. The gold standard is basically the idea that your paper money is backed in gold, that at any time you could take your paper bills somewhere and redeem them for a specified amount of gold. Now, I hear a lot of you say, why would you ever do that? Doesn't putting a currency on the gold standard just mean that we're back to the problem we were trying to solve in the first place? By tying money to gold, aren't we once again limiting the money supply? The short answer to that is yes, and we're going to see just how that plays out. The longer answer is, sort of. This is a pretty complicated economic question, too complex to really get into here, but the concise version is that having paper money backed in gold, rather than using gold directly, allows far more options when you need to expand the money supply. And it has the advantage of letting you play fast and loose with the system when you need to. But still, why would you do this rather than have your currency float free? Well, that's where history comes in. You see, the gold standard solves two major problems. The first is inflation. As you can probably guess, it wasn't long after people started printing paper money that they figured that they could just print a lot of paper money. Way more paper money than they could ever redeem. Way more than even our fractional reserve banking system thinks is sane. As soon as people did that, you started to get inflation. And it could still happen even with a central currency controlled by the government, because when countries needed to, say, pay for an army, they would sometimes just print more bills to do it. More bills means that each bill is worth less, which was a problem, not only for those poor citizens whose life savings were now in paper bills, but also for other countries who'd been accepting those paper bills in exchange for their goods. Which brings us to the second major issue that the gold standard addresses: exchange rates. Right as paper money was becoming the standard in Europe, international trade was really starting to pick up. The Industrial Revolution was getting into full swing, and raw materials and finished goods had to be shipped and traded at a pace never before seen. Simultaneously, mercantilism, that isolationist monetary policy that we discussed in an earlier episode, is coming to an end, causing trade to rocket to even greater heights. But what happens when your ship full of cargo docks in some foreign port, and you try to hand the local merchant your funny green paper money to buy their goods, while they try to hand you their funny pink paper money to buy what you've got on your ship? Well, you both just sit there scratching your heads for a while. Back in the...
Okay, so the class will see the old video. So in this video, we see that during World War First, the gold standard, several governments financed part of their massive military expenditures by printing money. This resulted in inflation, and by the war's end in 1918, price level was higher everywhere. The United States returns to the gold standard in 1919, and Great Britain in 1925, and France in 1928. By the start of World War II in 1939, the gold standard was started. Okay, so the agreements which Britain would establish that two honest nationals is the International Monetary Fund and the World Bank. Yes, under the agreement, also, what is the International Monetary Fund and what does they do? What do you think about this? And the World Bank and what is? Okay, under the agreements, all countries were to fix the values of their currencies in terms of gold, but were not required to exchange their currency for gold. Only the dollars remains convertible into gold at the price of 35 per ounce. Each country decides what is want its exchange rate to be the dollars and then calculated the gold per values of the currencies balance in that seller's dollars exchange rate. The IMF artists of agreements were heavily influenced by the world's financial covers competitive devaluations, trade war, high unemployment, hyperinflations in Germany and elsewhere, and general economic disintegration led a crisis between the two world wars. The IMF was trying to use the two ways to advance repressions of truths and combinations is discipline and flexibility. A flexing trend rates regimes impose disciplines in two ways. First, the need to maintain a flex exchange rate puts a brake on competitive devaluations and bring stability to the world's trade environment. And the second, the flex exchange rate remains imposed monetary discipline on countries that there's price inflations. The increase in the money supplies would lead to price inflations. Through flex exchange rates are seen as the means for controlling inflations and imposing economic disciplines on countries. The implications of the flex exchange rate would be too inflexible. A country's attempt to reduce its money supply's growth and correct a persistent balance of payment. The flex could force the countries into recent and increased high unemployment. Should be built limits flexibilities into the system. Two major features of the IMF articles of the agreements fosters these flexibilities. IMF leading flexibilities. Adjustable parties. The IMF stood ready to lend foreign currencies to members to tide them over during short periods of balance of payments deflect when the repetitions of monetary or fiscal policies would hurt demand employment. By providing deflation, countries with short-term foreign currencies then loans IMF funds would buy time for countries to bring down their inflation rates and reduce their balance of payments deficits. And the office name for the World Bank is the International Bank for Reconstruction and Development. The bank's introduced mission was to help finance the buildings of Europe's economy by providing low interest loans. In the 1950s, the bank concentrates on public centers projects, power stations, road buildings, and other transportation investments were much in favor. During in 1960s, The banks also began to lend help in support of a cultures, a rich cultures, educations, populations control, and urban development. development. The bank lent money under two schemes. Under the IBRD scheme, the bank offers low interest loan to risky customers whose credit rating is often poor, such as the governments of underdeveloped nations. IDA loans go only to the poorest countries. Borrowers have up to 50 years to repay at the interest rate of less than 1% a year. The world's poorest nations receive grants the interest-free loans. The system finally collapsed in 1973, and since then we have had the major's flat system. But why the system collapsed? As the only currencies that could be converted into gold and as the currencies that serve as the reference point for all others. The dollars occupies the central place in the system. Any pressure on the dollars to develop could have a squeeze the system, and that it what occurrence to finance both the Vietnam's conflict and this welfare program. President Lyndon Johnson backed an increase in U.S. government spending that was not financed by the increase in tax. Inside, it was financed by an increase in the money supplies, which led to a rise in price inflections from less than 4% in 1966 in close to 9% by 1968. At the same time, the rise in government spending had steadily halved economic. With more money in their pocket, people spend more, particularly on import, and the U.S. trade balance began to deteriorate. As the key currencies in the system, the dollar could be developed only if all countries agreed to centralism revalues against the dollar. Many countries did not want this because it would make their products more expensive relative to U.S. products. In 1971, an agreement was reached to devalue the dollars by about 8% against foreign currencies. The import tax was then removed. The problem was not solved. However, in 1973, the national money supplies continued to expand at the inflation rate that the second devaluations. The Bretton Woods system could work only as long as the U.S. inflation rate remained low and the United States did not run a balance of payments differs once testings occurs. Currents the system soon became straight to the breaking point. And now we look for the page 328. The Dreamcast meeting reviewed the IMF Articles of Agreement to reflect the new reality of floating exchange rate. The main element of the Dreamcast agreements include the following. And we can I I I got the 3 points is IMF members were permitted to enter the foreign exchange market to even out unwarranted speculative fluctuations. And gold was abandoned as the reserve asset. And total annual IMF credit the announced member countries contributes to the IMF were increased to 41 billions. And since March 1973, exchange rate have become much more volatile and this predictable than they were between 1945 and 1973. This volatility has been particularly due to a number of the shift towards monetary system. And there have two increased the price of oil dramatically. The unexplained rise in the dollars between 1918 and 1985. The rapid fall of currency between 1955 and 1987 and 1993 and 1995. And there have 3 times the currency crisis in Asia and the global finance and in the Europeans unite. A number of favorable factors overcame the unfavorable effect of the trade deflected strength economic growth in the United States, a trade's heaviest inflow of capital from foreign investors seeking high returns on capital assets, high real interest rates, a trade foreign investors seeking high returns on financial assistance. The fall in the value of the dollars between 1985 and 1988 was caused by the combinations of government interventions and market force. In 1985, the United States posted the then record high trade deficit of more than 116 billion, less than to grow in demands for protectionism in the United States. In September 1985, the plazas across announced that it would be described for most major currencies to oppress the US dollar and pledged in intervents in the foreign exchange market sterling dollars to encourage this object. In this section, we will review the agreements for fixed and floating exchange rates. Has the three main elements of the floating exchange rate have the three. Is the monetary politics autonomy and trade balance adjustments and crisis recoveries. And the first monetary policies autonomy is monetary expansions can lead to inflections, which put downward pressures on the flex exchange rate. Higher interest rate lead to an inflow of money from abroad, which puts upwards pressures on a flex exchange rate. Flows to maintain exchange rates parties under the flex systems countries were limits in their abilities to use monetary policy to expand or contract their economics. And the trade balance adjustment is the adjustment mechanism works much more smoothly under the fluctuating exchange rate regimes they around that if the country is running a trust deflect the imbalance between the supplies and demands of the country's currencies in the foreign exchange. Markets will lead to depreciations in this exchange rate in turn by making its exports cheaper and thus import more expensive. Exchange rate depreciation should current the rate deflect. And crisis recovers. Although under the flattening exchange rate remained dominant, inflections would have an impact on the exchange rate. It should have no impact on business international costs. Complete competitiveness due to exchange rates depreciations the risk in domestic cost should be exactly offset by the fall in the value of the country's currency of the foreign exchange market. Similar governments could use monetary policy to contract the economy without worries about the need to maintain partly. So, what is the fixed exchange rate? Okay, the case for fixed exchange rates reasons on a growth about monetary explanations on uncertainties and the leaks of consensus between the trade balance and exchange rate. And the first is monetary discourse, the need to maintain fixed exchange rates parity ensures that governments do not expand their money supplies at inflationary rate, while advances of floating rate around that each country should be allowed to choose its own inflation rate. Advocations of the flex rate around that governments ought too often give into political pressures and expand the money supplies for to replace causing unacceptable high price inflections. A fixed exchange would ensure that it does not occur. Traces of the floating exchange rates regimes also across that speculations can cause fluctuations in exchange rate. A small chance jumps on the bandwagons. The expectations of depreciations are released. Such detailed speculations tends to account the fluctuations around the exchange rate. Long rate exchange rate long run values. It can demand the country's economy by distorting export and import price. Speculations also add to the uncertainty surrounding futures currencies movements that charities flattening exchange rates regime led a flat exchange rates by eliminating such uncertainties promotes the growth of international trade and investments. Advantage of the floating systems reflect that the floor exchange markets ensures against the risk associated with exchange rates fluctuations, so the adverse impact of uncertainties on the growth of international trade and investments has been overstated. Thus, in factor of flat exchange rate growth, that fluctuation rate helps adjust trade imbalance and can assist with economics recovers after the crisis. Crisis questions the closeness of the links between the exchange rate, the trade balance, and economic growth. They claim trade deficits are determined by the balance between saving and investments in the countries, not by the external values of its currencies. The urgings that depreciations in the currencies will lead to inflections. Its inflection, the state will wipe out any apprentice gains in cost competitiveness that arise from currency depreciation. And so, who is right? Actually, the evidence is not clear. Speculations utilities broke the system of phenomenons that advocated of fixed rate regime's claim is assisted with fluctuating exchange rate. Nevertheless, nevertheless, a different kind of fixed exchange rate system might be more enduring and might force stability that would facilitate more rapid growth in international trade and investment. And governments around the world purchase numbers for different exchange rate policies. Some 21% of the IMF members allow their currency to float, and other 23% intervenes in only a limited way. A few further 5% of IMF members now have no spares that tenders of theirs won. These are typically states, mostly in Africa or the Caribbean, that have no domestic currency and have adopted a foreign currency as legal standards within their borders, typically the US dollar or the remaining countries use more inflexible systems, including a flex page arrangement under which they paid their currency to other countries such as the US dollar or the euro, or to a basket of currencies. Other countries have depends on the system under which their exchange rate is allowed to fluctuate against other currencies with the target zone. Under the package exchange rate regions, countries will pay the value of these currencies to that of the major currencies so that package exchange rates are popular among many of the world's similar nations as with the full flex exchange rate regions. The great virtuous claims for a package exchange rate is that it imposes monetary disciplines on the country and leads to low inflations. If evidence show that adopting a package exchange rate regimes moderates inflationary pressures in a country, and IMF studies conclude that currency-wide package exchange rate and an average annual inflation rate of 8% accounts with 14% for intermediate regions and 16% for floating regions. However, many countries operate with only a nominal and in the practice are willing to develop their country's rate then pursues a tight monetary policy. A country that introduced a currency sport commits itself to convert its demands currencies on demand into and other currencies at the fixed exchange rate. To make these commodities tradable, the currency board hold reserves of foreign currencies recurrent at the fixed exchange rate to at this 100% of the demand currency isn't. The currency board can issue additional domestic notes and coins only when there are foreign exchange reserves to bank them. This limits the abilities of the governments to print money and thereby place inflationary pressures. Under a strict currency board system, interest rates adjust automatically. If investors want to switch out of domestic currencies into, for example, US dollars, the supplies of domestic currency will shrink. This will cause interest rates to rise until it eventually becomes attractive for investors to hold the local currency again. Since its establishment in 1983, the Hong Kong's currency board has weathered several storms. This success pushes several other currencies in the developed world to consider a similar system. Also, under the currency board system, the government lacked the ability to set interest rates. Interest rates in Hong Kong, for example, are effectively set by the U.S. Federal Reserve. So now it's managed by the IMF. So what is the IMF? Look, IMF was conceived in the July 1944 at the United Nations Bretton Woods Conference in New Hampshire, and the IMF's primary mission is to ensure the stability of the international monetary system, the system of exchange rate and international payments that enables countries and their cities to transact with each other. The IMF orange function was the provides a pool of money from which members could borrow short terms to adjust their balance of the payments and manage their exchange rate, just like the opening case, the Pariston. Some believe that demand for short-term loans would be considered rate balance diminished under the flattening exchange rate. Regarding a trade deflect would presumably lead to a decline in the country's exchange rate, which would help reduce import and boosting export. No temporary IMF term loan would be need concerned with this after 1973. Most industrial countries tend to that the foreign exchange makers determine exchange rate in respond the demand and supply. Since the early 1970s, the rapid development of global capitalist markets has generally allowed developed countries such as Great Britain and the United States to finance their deficits by borrowings private money as opposed to drawings in IMF funds. In 2019, the IMF had 189 members, around 40 of which had some kind of IMF program in place. IMF led increased agents in late 2008 as the global financial crisis to hold between 2008 and 2010. The IMF made more than 100 billion in loans to troubled economies such as the Latvians, Greeks, and Irish. So now is the number of the broad type of financial crises have occurred over the past 30 years, many of which have required IMF invest. So, what is the three crises? The first currency crisis, and second is the bank crisis, and the third is foreign defense crisis. Yeah, so these careers tend to have comments on dirty macroeconomic cases, high relative price inflation rates, weakening currency according deflect excessive expenses of domestic borrowing, high government deflect, and asset price inflections, such as a sharp increase in stock and properties. At times, instead of the currencies bank and the debit crisis may be present simultaneously to assess the frequency of financial crises. The IMF looked at the macroeconomic performance of the groups of 53 countries from 1975 to 1997. The IMF found there had been 158 currencies crises, including 55 inflows in which a country's currencies delisted. Also 54 banking crises that developing nations were more than twice as likely to experience currencies and banking crises as developed nations. So by 2019, the IMF had programs in around 40 countries that were struck with economic and or currency problems. The IMF has always insisted on the confluence of tier microeconomic publics, including cut in public spendings, higher interest rate, entire monetarist policies. It has also often pushed for the regulations of sectors for metalist protests from domestic and forest completions, privatizations of state-owned assets and better financial reporting from the banking sector. But this set of police prescriptions has comes in form of critics from many observers, and the IMF has started to modify its approach. In the case of the 1997 Asia crisis, around that the type macroeconomics policies in place by the IMF were not well suited to countries that are suffering not from excessive government spending and inflation, but from the private sector debt crisis with deflationary undertone. Even South Korea had the second strongest financial positions of any country in the organizations for economics cooperating and development. The IMF still applied the same policies that applies to countries suffering from high inflation to Korea. The South Koreans would be forced to apply an unnecessarily high monetary political policies. A second criticism of the IMF is that its resource efforts are exacerbating a problem known to economists as moral hazards in 1990. This crisis around that the bank should have been forced to pay the price for their restandings police only by taking drastic actions. The ground goes well bank learn the errors of their way and not errors in restanding. These errors are two correspond. First, if some Japanese or Western banks with heaviest exposure to the troubles, assets economists were forced to write off their loans due to widespread debt default. This impact would have been difficult to contain. In 1997, Asia Financial closes First Bank with short-term loans outstanding to South Koreans, and trippings have been forced by Christmas tense to reduce those loans at interest rates that do not compensate for the extensions of the loan maturity. And the final criticism of the IMF is an institution that lack the real mechanism to have in place accountability. It is not clear which side is correct about the apparatus of IMF police. There are cases there one can around the IMF policies had been counterproductive or the only had limited success. And the current system is the mixed systems in which a combinations of government's interventions and speculative activities can drive the foreign exchange market. Under the present systems, speculative buying and sales of currencies can cause very volatile movement in exchange rates, contrary to the predictions of the purchasing power parties. The exchange rate movement during the 1980s and 1990s often did not seem to be strongly influenced by relative inflation rate. On the other hand, the foreign exchange markets has developed a number of instruments as the forward markets and swaps that can help ensure adjust foreign exchange rates. The volatility of the current global exchange rate presents a conundrum for international business. Exchange rate movements are difficult to predict, and yet their movement can have a major impact on business competitive positions. The roles of the IMF and the World Bank in the current international monetary system also have implications for business trade in the short run. Such policy usually result in a shared contraction of demand. In the long term, it can promote economic growth and expansions of demand, which creates opportunities for international business. As major players in the international trade and investments environments, business can influence government policy towards the international monetary systems. However, exchange rates volatilities such as the world experienced during the 1980s and 1990s creates an environment this conducive to international trade and investments than one with more stable exchange rate. Therefore, it would seem to be in the interest of international business to propose an international monetary system that minimizes volatile exchange rate movements, particularly when those movements are unrelated to long-run economic fundamentals. Thank you.